Okay, ladies and gentlemen, welcome to MACROACE with your host, Tony. Thank you very much for joining me. Don't forget to like and share the video and also subscribe to the channel. We've got quite a bit of data and prep to go through. What's this all about being bored? You guys are crazy and nuts. I love you guys. Somebody's calling for 75. Well, that's... you never know. Anyway, FOMC, as I said, we've got a lot to kind of go through with the rate decision. So what is the rate decision first? So they roughly meet every 6 weeks over a two-day period and discussing where to set the interest rate, what sort of monetary policy to go ahead with, and then also talking about maybe any future guidance or further forward guidance, particularly during the SEP or Summary of Economic Projections, which of course we had at the last meeting. We won't get that today. So all we're getting today is the rate decision, the rate statement, and then of course Fed's Powell at 2:30 p.m. Eastern Time. So for those of you who don't know, the scenario how we do things, we do for the interest rate decision for the FOMC an hour prep beforehand. Of course, at 2 p.m. Eastern Time, we have the interest rate decision. And then what I'll do is I'll kind of go through, try and summarize what had happened, what was said, why the markets reacted in a certain way as quickly as possible to deliver the information to you guys. But let's go through some other things as well with the Fed rate decision. So, of course, it's the rates that banks charge each other to borrow, lend excess reserves overnight. Only like Nerd says, I appreciate you, FinancialJuice. Thank you very much. Appreciate you too. So why is it important? Of course, it causes volatile moves within the markets and affects the wider economy. Whatever the Federal Reserve does, that's the top rates, okay, or the top level of controlling money flow within the economy and controlling, how well the economy performs, either to dampen maybe aggressive or maybe very strong productivity, or to boost it, with maybe cutting rates or monetary easing with their policy. So they have a very big influence, not just within the US economy, but also what happens in the rest of the world too. If the US has a high rate of interest, if you're investing in the dollar currency, or if you have an interest rate, or if you have a savings account in the US, then that will affect how you would interact with the US, and also businesses too. If businesses in the US have a higher rate of interest, are they going to charge a higher amount for their business to other nations outside, globally as well? Does it make it harder to attain the dollar for international businesses to use if that's cash is king, if that's the dominant force within the world economy? So there's also that effect too within the for the interest rate decision. Then, as I said, it also may influence other central banks to follow in its rate path. We've seen in the past, or last year, where the central bank has taken a bigger step, like a 75 basis point hike, and then you have the Saudis and the Kuwaitis, who usually follow pretty much as soon as the rate is done, with a big rate hikes with themselves as well. But also affects how other central banks view their monetary policy, whether or not they need to align themselves with or near enough to where towards the Fed's goal or similar goal, to try and keep their monetary policy stable so they don't fall behind the US. But there's also the opposite to be said as well. So the Bank of Canada being the first central bank to say that they're going to pause at the next meeting, already reaching their terminal rate of a forcible 5% and going, that's it, ladies and gentlemen, that's where we're going to stop. Does that mean the Federal Reserve and other central banks are going to be following what the Bank of Canada does? Well, that's yet to be seen. We still have quite a bit of data to go through. Inflation is still much higher, or more than three times higher than the Federal Reserve's target of 2%. So and the jobs market is still relatively strong. So there's still a lot of work in the US to do compared to the Canadian economy and where they're at the moment. Now, how does it affect the markets? What's important to you guys to understand? So Caroline's awesome says, I wasn't expecting a cool accent. Thank you very much. Hope you enjoy it. So how does it affect the markets? What's important to you guys to understand? So currency, whenever interest rates are raised, the currency usually appreciates when it's raised much higher than expected. Of course, if the interest rate is higher, then that brings up the value of the currency, as there are more investors who are going to put their money into dollars because they're going to get a higher rate of return, and the economy is seen to be on a stronger footing as well, enough for the central bank to raise rates and sees more confidence that the economy can handle those interest rates as well. So main reason is to boost confidence within the currency. Of course, as said, you would expect a higher rate of interest than expected. Of what the forecast is to see a big appreciation from the currency. Usually when it comes in line with expectation, you're looking towards the monetary policy statement or the summary of economic projections when that does come out the next time around, to give traders an idea of how hawkish or dovish or neutral the Federal Reserve or any central bank may be in order to influence the currency. And that goes for the same for stocks and bonds as well. Now, for the stock market, when we're talking about the effects of that, whenever interest rates are raised, that's always bearish or negative for the stock market in the wider economy. Okay. Now, within the, of course, higher rate of interest means higher borrowing cost. It costs more to do business or buy products or produce the goods or provide the services needed for consumers or other businesses as well. So that has a wider effect on the not only the stock market, but also the US economy itself and businesses, whether they be large or small, how they operate within the economy. Now, within the short-term reaction, that's the key point. Is there a deviation from the expectation, whether it be higher or lower? If you do get a high rate of interest, let's say they do go for a 50 base point hike instead, rather than going for the expected 25 base point hike, then that will cause some pain for the stock market if they're expecting the Federal Reserve to ease off the brake with their acceleration, with their drive of going with high interest rates. That can rock the market and cause the stock market to say, go, uh-oh, we're wrong. This is much higher than expected, and this is not good for the economy because that's going to hurt businesses even more if businesses are trying to prepare for the central bank to raise the rate to a certain amount. Okay, everyone has a schedule. They've got to meet it, but if the Federal Reserve rocks the boat, that's not always, and it doesn't go to plan, then that's it. There you go. You get the legs cut off from the stock market. But if you do get something lower than expected, or maybe if the Fed does go for a pause at this meeting, which doesn't seem likely because of what our Fed members have said in the past, and we'll go through those comments, then you would see a more appreciation that the Federal Reserve could get to their point of starting to cut rates sooner rather than later, or maybe ease off the brake with monetary policy tightening much sooner in other areas too. Now, for the bond market, easy way to think about it, if interest rates go up, bond yields also rise as well, because that's traders pricing in a higher rate of interest. If it's higher than the markets have expected it, and then bond prices would go lower. Okay, so if bond yields are higher, bond prices are lower. And the tightening cycle, as I said, it's traders pricing in a higher rate of interest. Within a normal environment where there's no hiking or tightening, no hiking or cutting of rates or tightening or easing monetary policy, if you do get a higher rate of interest, then it could be that the economy is in a strong position, the stock market is doing well. So what the government does, that they raise the bond yield and lower the price to attract those traders, or to attract investors, say, hey, why don't you buy some government debt? We'll give you a nice high rate of interest back. So that's two ways to kind of look at how bonds react and why they would react in that way. Now, where is the economy at the moment? So GDP quarter on quarter, which we had last week, is at 2.9% for the fourth quarter. The advanced data versus the final data of Q3 of 3.2%. Now, the fourth quarter data was much better than forecasted. Forecast was 2.6%, so that caused the dollar to see a bit of appreciation of that data. Stock market, there was a bit of a movement towards the downside, but it wasn't as big of a movement as what we would have seen in the past. Inflation, of course, is 6.5% compared to the prior of 7.1%, so a nice downward movement for inflation. That's CPI year on year. The PCE price index year on year at 5% versus the prior 5.5%. Consumer spending, which we had recently as well, last week at minus 0.2% versus the prior of 0.1%. Non-farm payrolls, which of course we're going to be getting Friday, was at 223k versus 263k. That this Friday is expected to cool even further to around 185k for the month that's just gone. ISM manufacturing PMI, which we had today, is at 47.4 versus the prior 48.4. So cooler than expected picture. And usually when you get to 47 or 40 or around that 47 number, that's considered as recessionary for the economy, or that part of the economy in the manufacturing sector. So we're kind of hovering around that there. But more or less, that's kind of expected that the manufacturing sector would take a bit of a hit off the back of the rate hikes that we've seen from the Federal Reserve. University of Michigan sentiment as well, we had last week at 64.9 versus 64.6. University of Michigan 1-year inflation outlook at 3.9% versus 4%, so a smaller than expected inflation rate. Remember, the consumers are also important too. Where do they expect inflation to be? How hard do they expect to be hit by inflation? And if it's going down, that kind of plays into the hands of the dovish side of the Fed or the Fed members saying, yeah, inflation is peaking, we can do less, we don't need to be that aggressive with the monetary policy as well. Then for 5-year inflation, again, 2.9% versus a prior of 3%. And then employment costs, okay, a release that doesn't really garner a much traction. Only when it matters does it have a reaction. The Fed's main goal is bringing down inflation, okay, wherever that may be. And employment costs, right, is one of those key metrics that the Federal Reserve looks at and keeps an eye on. Now, it comes out quarterly, so it's not a weekly or monthly release. So it bore quite a bit of importance to the market when it was lower than expected. It was expected to go down to 1.1%, came in at 1%. That caused the dollar to see a decline and the S&P 500 to go to fly, because it's seen that inflation pressures are abating much more or slightly more than the markets were expecting. So if you are trading, yeah, you just got to be careful of these smaller releases that show how inflation pressures are within the US, that they might cause a bit of a stir within markets depending on which way they go, or if they do move at all. So that was one of the let's say positive points for the markets yesterday, when that came in lower than expected. But again, compared to the prior, it was at 1.2%. Now, the previous FOMC decision at December 14th. So we've had 7 interest rate increases. Okay, we had a 50 last time around as a step down from 4 75 basis point hikes. Now we're looking at a 25 basis point hike from the Federal Reserve because of how inflation has been. And they feel that, of course, the robustness of the jobs market won't do too much damage to the Fed's goal of attaining the 2% inflation target. That they can still, if they do pause, that rate will kind of slow down the market by itself, and the economy will reach the Fed will reach its 2% inflation goal. So what happened last time around? What was said? Recent indicators point to modest growth in spending and production. The war and related events are contributing to upward pressure on inflation and weighing on global economic activity. That's something that's been repeated quite a bit throughout the statement, but still something to be aware of, that there are still the war effects that are having an effect on the US economy. The committee anticipates that ongoing increases in the target range will be appropriate in order to attain a stance on monetary policy that is sufficiently restrictive to return inflation to 2% over time. The Fed will take into account the cumulative tightening monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. So saying, let's see what happens with the markets. Excuse me, not the markets. Let's see what happens with the economy when we pause. If we do pause, if we do go with smaller rate hikes, and then see what kind of fruit do we bear from that, or do we get a rotten bitter fruit where the economy isn't performing as well as it needs to be in the Federal Reserve's eye, and maybe that could pull forward when the Federal Reserve could do a rate cut. Maybe that's a maybe, right? It's not a certainty, but this is just them saying, okay, let's kind of see what happens, and we'll kind of step down with our aggressiveness and see how the economy reacts. Then if we keep going forward, so this is quite important too, who's a hawk and who's a dove. When you do get comments from the Federal Reserve, this is just a nice little picture from In Touch Capital Markets. It gives you a summary of, so you've got Harker who's a member, who's a voting member, Goolsbee, Cook, and Logan, and then you have Kashkari and Waller. Kashkari wasn't a voting member last time, so that's quite important just to understand who has the ability to vote, but also carries more influence within the rate decisions. Okay. The Fed minutes then. So on the 4th of Jan, so they said that fourth quarter GDP expanded modestly after expanding strongly in the third quarter. It was slightly weaker than the third quarter data, but still, it was still quite strong. It wasn't a massive, crazy big figure, but still better than expected, what the markets were expecting. Labor conditions eased somewhat over October and November, but remained quite tight. Wage growth continued to be elevated and remained above the 2% inflation objective. Economic growth was still forecast to slow markedly in 2023 from its second half pace. Staff still view the possibility of a recession sometime over the next year as a plausible alternative to the baseline, i.e., the baseline being that there's a little bit of negative GDP or productivity that creeps in to the economy, some downside, or maybe a slight drop in the employment figures and also consumer spending, but it won't be. But then, they're not putting off the idea that could be worse, or could be worse, should I say, in the year ahead. The yield curve inversion as well. So this is also important too. Now, if you remember ages ago, I was talking about the yield curve inversion. When the yield curve shows the inevitability or the expectation of a recession, usually, from what Fed's Daily has said in the past, when the 3-month rate is higher than the 30-year rate, that shows that short-term interest rates are much higher than the longer-term rates. That means that traders have bought a lot of the longer-term rates because they don't know how long a recession or how big a recession could last within the US, so they go and jump into those long-term bonds rather than shorter-term rates. Or what other investment banks, a couple of investment banks have been saying, is that it could mean that those traders or investors, should I say, are pricing in the possibility of a rate cut coming in the second half of this year, or maybe towards the end of this year, and whether or not, or just pricing in a slowdown in the interest rates hikes that the Federal Reserve is doing. So that's something just to be aware of, and this is what it currently looks like at the moment. So if we're looking, this is back on the 23rd of Jan, still more or less the same, blue one being the current one, still more or less the same. So you have the 3-month around here, 3-month bill, and of course the 30-year here. Okay, so this is what it was like, this orange one, about 6 months ago, about a month ago, November 15th, if I remember correctly. When we had the rate decision, then is when the yield curve inverted, and we had the 3-month bill that was higher than the 30-year yield after the after that rate decision. But that's something to be aware of. What are bond investors? What are they looking at? How do they view the economy, and what do they view the Fed doing? So either they're predicting a recession, which is what it's done in the past, or the latter of the central bank maybe cutting rates sooner rather than later, or easing monetary policy rather than later. So Fed voting members then. So Powell said, I don't see us considering rate cuts until we are confident that inflation is declining in a sustained manner. Kashkari said that the Fed should then hold the target interest rate. My forecast is that it would be at 5.4%. So quite hawkish there in his comments back in January 4th. Considering that a lot of members have been looking at the 5 to 5.25% target range recently. 10th in, so you had Powell in his prepared remarks didn't discuss any monetary policy, which the markets at that point were fearing that the Fed's Powell could say something very hawkish, maybe give even more comments about where he sees the economy, but he didn't. So the markets were kind of trading low on that day back on Jan 10th, and when that came out, it doesn't mention anything about monetary policy. Then the markets were, hey, and the stock market started to go back up. So even if we don't, post the interest rate decision, there's still that fear that the markets have of, even though we are nearing towards maybe the end of the tightening cycle, there's still that in play. With the big dog, if he does say something or nothing, that's going to add to volatility within the market. Fed's Logan wants a 25 basis point rate hike, not a 50 basis point hike on January 18th. Fed's Brainard saying recent data indicates slightly better chances of avoiding a recession. Fed's Harker said that he supports moving to 25 basis point interest rate hikes, and he sees the Fed raising rates a few more times this year. So that could be in March and in April, although we could see maybe a couple more hikes. Depends. Does he mean longer than that? We don't know. That's not been clarified by Fed's Harker. Fed's Waller also saying that he favors a 25 basis point hike at the upcoming meeting, followed by additional policy tightening. And based on the summary of economic projections that we're talking about, another 75 basis point of hikes, followed by a pause. Okay, so still more than what the markets are expecting. Expecting maybe a couple more 25 basis point hikes at the next couple of meetings, but one of the members just giving their thoughts there. So non-voting members. Bullard said inflation is likely to slow. Expectations are in line with the Fed's 2% target. Inflation is likely to ease more slowly than the markets anticipate. So there is the harbinger. Well, he's acting as a bit of an omen, saying, yeah, inflation isn't going to slow as much as you think it is going to. So there's also that thought that, does the Fed need to sustain their rate hiking path for longer? Maybe, but if that's what Fed's Bullard is saying, but he is known to be very hawkish on the spectrum of other central bank members, barring Waller, who is the most hawkish, or considered the most hawkish from the image that I just showed you towards the beginning. Daly said that something above 5% is absolutely likely for the peak rate, and it is reasonable for rates to be 5 to 5.25%. That's Collins says, I think 25 or 50 would be reasonable, and I'd lean to 25 at this stage, but it's very data dependent. That was in an interview with the New York Times. Then later on the 19th of Jan, she said that she wants us to slow the pace of rate hikes due to risks being more balanced. Okay, so there's also that playing into factor two, that of course with inflation data that when that had come out, that have played its part as well. Fed's Barkin said the median CPI is still too high for what I want to see. So according to, if we're looking at one of the measures for median inflation that is done by one of the regional banks, that 6.9% is what is seen as the median CPI, what we were seeing back then. So that for Fed's Barkin is still too high, and that for him would mean, or would imply, the need for continuing to raise interest rates. Fed's Mester said policy rates should rise a little bit above 5 to 5.25% range projected by policymakers for the end of 2023. So that just all you need to know or understand is that Fed members are still looking to raise rates. There isn't any talk of when a pause could, or how soon a pause could occur, because it could maybe later on down the line, if they wanted to reach a high rate of interest, could go back to a 50 instead later on. Doesn't mean they're going to do in this meeting. You never know. They could surprise the markets. But with the data that we've received recently and how the Fed has been data dependent, economists, are kind of being backed up by the fact that it is expected to be a 25 basis point hike. But that doesn't put it a surprise out of the question, as we've seen from the Bank of Canada in the past. Then the previous SEP or December meeting that we had, so you can see that the markets didn't like the fact that the Federal Reserve raised their expectation for the federal funds rate in 2023 to be at 5.1% compared to 4.6%. And then going to 2024 is that when they would potentially slow rate hikes to 4.1%, okay, compared to 3.9%. So that's just obvious that they need a high rate of interest to kind of tackle inflation. What they measure is their favorite inflation measure is PC inflation. Seeing it at the 2023 at 3.1% and then 2.5% in 2024. So more or less, between that time period of 2023 to 2024, when they could pause or cut rates, that's when they think they've more or less done the job that they need to do. Okay. Then foreshadowing. So you have the price survey primary dealers. Now we looked at the November one at the last rate decision. The December one gives you the expectation of what the investment banks who are surveyed by the New York Fed, where they expect the rate to be, and what they, and when they expected to reach that rate. So you can see the median estimate is for even in May, they're expecting, March rate hike to, around 5.13%, or let's say 5.25%, around that rate there. So, of course, we're not anywhere. Well, we're close to that. We're not near it exactly. It's still, as I said, a 4.5%. So we've still got a little bit of a way to go, just a tiny bit of a way to go until we get that towards the median range. And then if we're looking at what the December expectation for the Fed meeting is, so they're looking. So this is quite important here too. Okay, this is back then, before we had the CPI data. So of course, back then they were looking at maybe a 50 basis point hike. It was at 47%. And then they have this bit of data here looking at 38%. So this is old, of course, but still important to understand how the expectations quickly changed. So the expectation to a 25 basis point hike rather than a 50 basis point hike that was expected then back in the primary dealers survey in December before the last rate decision. Okay. Then CME Fed Watch, what we've seen on what I looked at on the 20th of Jan on Friday, basically pricing in more or less a 25 basis point hike, and that's still the same story today. That hasn't really changed or hasn't gone in favor of 50. Okay. Then investment bank views as well. So you had Jan 12th on Goldman Sachs post CPI data that said that they see the report as solidifying the case for a step down to a 25 basis point hike in February. They continue to expect 25 basis point hikes in each of February, March, and May. Okay, so this meeting, March and May, so a couple more. And then Solomon, CEO, also stated that he's hearing increasing signs that the economy may be able to avoid a widely feared recession. So there is one, that the economy is able to weather the storm of these strong or super quick strong rate hikes and getting to a high terminal rate. And also be able to deal with, of course, any other issues that may come through with the rate hikes. Of course, consumers being hit by it too. Not just businesses who are going to take, the small businesses, let's say, who will take small to medium-sized businesses that will take the brunt of these rate hikes. January 19th, so you had from according to a poll, 55 of 89 economists polled stated that the Fed is more likely to hold rates stable rather than decrease them this year after hitting the terminal rate. And the central bank will hike the Fed funds rate to 4.75% to 5% level by the end of March, then pause. So a 25 basis point hike in this meeting and then at the next one, and then look to pause. Okay, so that was on January 19th. Bank of America, Ethan Harris said that I don't think Powell wants the markets to surge as a result of this meeting, i.e. think that the market will think that the Fed is going to cut sooner rather than later. That's what Powell doesn't want to really happen. And we've seen in the past with him trying to be hawkish with his press conference, and also the statement that was that has been presented in the past as well. So again, Powell doesn't want to provide fuel to this kind of hopeful narrative. Again, if you do start talking about the prospect of a rate cut, then the markets or the stock market will enjoy that, and the value of the currency or the dollar will start to depreciate if he gives more whiff of maybe we could start pausing, or maybe we could start cutting interest rate sooner rather than later. And there's also that aspect to be aware of. Okay. Then TD Ameritrade's cruise on US employment index costs, again back to the release that we had yesterday, that it doesn't really matter until it does, and the market wants the Fed to get a sense that inflationary pressures are abating. Again, something the Federal Reserve does keep a strong eye on. Then market pricing, of course. So you had Fed swaps post the last meeting that upgraded to a 50 basis point rate hike likelihood in February. Okay, Fed swaps on January 5th were pricing peak policy rate higher than 5% in 2023. Jan 6th, the following day, Fed swaps show further slip in hike bets. Cycle peak seen at 5%. And then, post the CPI report that we had, Fed-linked swaps show cycle policy around 4.97% after the CPI data, and Fed swaps indicate 29 basis points of increase in rates for February, i.e. a 25 basis point hike, and show less than 50% basis point combined hikes for February and March. So you see how the inflation data changes the narrative, not only for Fed members, right, and investment banks, but also the markets themselves as well. Of course, they're going to be reacting to the data instantly and trying to price in what the Fed is going to do at the upcoming meeting. So that's what the current scenario is at the moment now, right? That we've got to be aware of, okay? If these traders and investment banks are looking towards a 25 basis point hike. So if there is a surprise of the Fed going with a 50 basis point hike at the meeting, that is likely to cause some havoc if markets have been pricing in something different, right? It's all about the expectation when you're trading these interest rates. And then if the data does come in, if the rate does come in as expected, it's what's said in the statement or the summary of economic projections, as said, not today's meeting. The next one, what's said in that statement that could rock the boat or keep the boat steady and markets don't really move that much. There's also that to be aware of and to understand, you know, just what was the sentiment for the market and what are they expecting from the interest rate decision. So don't forget, if you're joining me now, or if you've been watching the stream so far, we've still got a little bit to go. We've got about 25 minutes left until we go ahead with it. So we don't have we've got a little bit of time left till the rate decision. But again, just something to be aware of. So if you have been watching the stream, don't forget to like it, share the video, subscribe to the channel, get the word out there if you found the information useful so far. We've still got a little bit of ways to go. So this is the last rate decision. So what we're going to show here kind of loads up. Ooh. if it wants to load. It's about 10 seconds before the release. And then this is how the markets reacted. So it's seen the markets moving towards the downside off the back of that data there. Now, the reason as to why we'd seen that market reaction, if you are a subscriber of the MACROACE mailing list, what I do is provide the deviations for how the economic release affects the market in currency, stocks, and bonds, and also, of course, gold as well. Now, the reason why we've seen this movement towards the downside, probably have to put it at a lower level. See if that does it. There we go. So now I can bring it back up. There we go. So the reason as to why the movement happened like this was because the Fed's median view of Fed funds rate at the end of 2023 is seen at 5.1% versus 4.6% in September projections. It's higher projected rate that led to stocks declining and the DXY to see an appreciation. Of course, if you're looking at the bond prices or the 2-year bond that we're looking at here, it's seen that depreciation in the 2-year bond price, and gold had also seen a depreciation as well. If I kind of skip forward, see if I've got that in there. Okay, so yeah, so gold, if I bring up the deviations, that will give you a better idea. So here we go. Just clearly, dollar went up, stocks went down, bond prices and gold went down as well. So again, as said, it's all about what the expectation is and what's said in the rate statement that kind of rocks the boat. So now the FOMC deviations. So if you don't know what you're looking at here now, I'm covering the press conference. No, I am not covering the press conference. It would just be the rate statement and, of course, the interest rate decision itself. That's what I'll be covering. More or less, it's more of a repeat, and there might be... it's good to sit and watch and listen to what Powell says, but it doesn't really bring too many surprises or anything to kind of go off on. Hardly happens. But this is the deviations from the last time round that we had from the rate decision. Okay, so the deviations, as said, shows you how the markets reacted to what the figure was or what the sentiment was for the interest rates decision. Okay, now here we can see that of course, we have the forecast and where the actual figure was, showing the deviation here if there was one. You can see when there was a bigger deviation, or if there was a deviation, that there was more whipsawing within the markets that had occurred. There's more strength in the markets. But here we had it last time round, right? So even if the data is higher than expected or lower than expected, it's also what the monetary policy statement says. So we had data was in line with expectations, so no deviation. Now, as said, the reason as to why the markets have moved or had seen that sort of movement and volatility is the Fed's median view of Fed funds rate at the end of 2023 was seen at 5.1% versus 4.6% in September projections, which led to stocks declining. Now, the number here, okay, we can see. So the first figure represents the initial reaction going to the wick of the candle, okay, just to show you how big the movement was. And then the figure in the brackets shows you the movement 10 minutes after going to the end of the candle. I always prefer looking at what the initial reaction was of the markets, and then showing how much it moved afterwards. Okay, so here we had the S&P 500. Now this is completely free. Okay, so if you're wondering, how do I get my hands on this? What do I need to do? Well, as I said, it's completely free. All you've got to do is sign up to the MACROACE mailing list. Okay, so you get a... no, it's not a 5-minute candle. This is a 1-minute candle. Okay, so this is the first minute. Okay, and then going to 10 minutes post release. If that was your question. So this is sent. This MACROACE mailing list. Not only do I provide you, we provide you with the deviations for the upcoming economic releases, but also a summary of what to expect for the week ahead in Asia, the US, and the European session, with a link to the live streams as well. Now, there isn't a big amount that's put into that MACROACE mailing list and that email. One email every Sunday. Okay, it's just more of a short and nice and sweet bit of a summary of what to expect in the different sessions, a summary of the weekend news as well, because I'm addicted to news. Who's not? If you're trading markets and you want to understand what's going on in the markets, so we're analyzing them constantly and analyzing news and politics, what's going on. That's also included in that as well. So again, as I said, completely free to sign up. The link is there in the chat for you to have a look at. Basic Goat says you're the goat. Sagar said I signed up to the macro list but didn't receive it. Okay. Send me an email to tony@financialjuice.com and then I'll get you set up with it. So just email me the data, or just email me that way. Just keep it private. Don't put your email on here, dude. If that were you, you don't do that. You never know what anyone could do on the internet. But yes, as I said, short and sweet. The juice, or the honey comes with me explaining what to expect for the economic release in these live streams that I'm doing here at the moment. Okay, so what we can see is that the stock market didn't like it at all. We had seen that the S&P 500 had seen 136 ticks down. The NASDAQ had seen 619 ticks down and had seen a bigger post-market reaction 10 minutes later compared to the 21st of September, which had seen the biggest reaction to the rate decision when we were looking at it. It was at 839 ticks 10 minutes after the release. Okay, remember, so it's on a 1 minute candle that we're looking at it on here. The Dow was at 242 ticks down, and after 10 minutes of trading, it was down 405 ticks. Okay, now gold, obviously very easy, and it was down 148 ticks, and after about 10 minutes of trading, 121. Now the currency market, it's not. Of course, we have more data to look at to understand what's the biggest mover. But what we've seen recently, the biggest move in the currency market in the last two meetings has been the dollar yen. One, that's because of how the Bank of Japan has continued with their, more or less continued with the monetary policy easing. Of course, when they did increase their yield band to spot 5%, okay, from spot 2.5%, that of course the Japanese yen strengthened, but then they said, nah, we're going to stick with the monetary easing and we're going to try and control that band, and it doesn't mean we're going to eat, or it doesn't mean we're going to start becoming more hawkish anytime soon. So then the yen weakened off of those comments from the Bank of Japan at their last rate statement, or last decision that they had made. So the dollar yen could still be that. So for the dollar yen, it could be the biggest market mover in the currency market. If we're looking at what's the second biggest mover, it's cable. Of course, you're thinking about where the Federal Reserve is and what kind of problems the UK faces with Brexit, with the energy crisis and the effects of the Russia or Ukraine conflict. Also, how they're dealing with inflation and being in a recession as classified by the Bank of England. And we've seen two back-to-back bits of data of negative GDP data, and as I said, Bank of England considering the UK being in a recession, so that to be that in effect too. And then you have the euro dollar. So dollar yen, cable, euro dollar. Okay, those are the three biggest movers that we've seen within the past. Then the bond market, you're looking at the 2-year bond price, or the 2-year that's seen about 50 ticks down, and after about 10 minutes of trading was down 57. Okay, so that is the deviation. So what we're looking out for, first of all, if we do get 25 basis point hike, does Fed's power try to become more hawkish to try and dampen the expectation of markets expecting a rate cut at the end of 2023 or in the second half of 2023? Does he try and say, hey, no, look, inflation is still strong, it's much higher than it's still higher than we anticipate, higher than we anticipated, or we need to continue raising rates. Doesn't mention anything about the possibility of a rate cut or in 2023 or at the end of 2023 rather than in 2024. Okay. Does he kind of switch it up and say, hey, let's play ball, let's keep a straight face here, let's go Kobe, and we've got a job to do, we've got to get inflation down to 2%. We got to do whatever we got to do to get to that 2%. So there's also that, but also talking about maybe the jobs market still being quite strong and that having an effect on the Fed's goals in the future, and more or less. And if he does, say if maybe there's a pause that needs to be done later than 2024, or excuse me, maybe we're keeping the rate at a terminal rate later than 2024, that would be very, very hawkish, and the markets wouldn't like that as well. And if it's higher, or if he expects it to be higher, but we don't really get that many comments from Fed's Powell talking about future forward guidance other than from the summary of economic projections, which unfortunately we don't get today, as said at the next meeting. Okay, so we've got about 14 minutes till the rate decision. So let's see. So here we go. So here you are. So this is just doing it right there and then. Okay, this is how the markets reacted. Right, and then I just kind of take note of testing and just kind of see what happens. So there we go. So that is the deviation there for the economic release. As said, we've got about 13 minutes now. The FOMC rate decision, of course, today we have our very own Drew on the FinancialJuice team who's going to be reading the interest rate decision. Now, how do you get to listen into that? To live voice and text service. Okay, so what you can do is sign up to FinancialJuice. Okay, now what is a live voice and text service? All it is letting you know about what's happening within the markets, what's been said by political members, maybe central bankers around the world. What are they doing? What are traders expecting for the interest rates? What are traders expecting for the upcoming rate decisions? And then also talking about what else they could do, what else they maybe expect for, maybe geopolitical events. So that is what a live voice and text service is. So a lot of what traders do, and this isn't something that the everyday retail trader has access to. More or less investment banks have access to a live voice and text service because they want to, first of all, manage any risks that they have within their trading, to keep an eye out for maybe potential opportunities to jump into the market. And again, as said, it's usually not readily available to the everyday retail trader. If you're a day trader, you want to know why the markets are moving, what's being said, and more or less manage your position, protect it, or maybe take the opportunity to scalp the markets and jump onto that volatility roller coaster and enjoy that ride. So that's again another benefit of having a live voice and text service. So FinancialJuice, here we are, the financial site. You have your text headlines coming through here. You have your economic calendar as well here, also in live real time. A voice in live with live real time voice as well. That presents you the news of what's what to expect. And that's also one thing to bear in mind is that if you do want to sign up to the pro version of FinancialJuice, the difference between the pro and light version, or the free version of FinancialJuice, is one, there is no delay to the website. Okay. Two, there are no adverts or advert banners or adverts that are played. And three, as said, everything's in, you have access to the news desk to ask us questions as to why the markets are moving, what's kind of going on, or get an understanding of what to expect for, what to expect for the day ahead news-wise, or what the markets, or maybe what's affecting the markets there and then. All right, so 10 minutes left till the rate decision. Now, the other thing to bear in mind, so Financial Juice. So if you want to sign up to Financial Juice, we have, so you can sign up here. That's the link. I'll pin that in the chat too so we don't lose it. Okay, that's there for you. Now, the expectation is that if you do want, so if you do want the live version, okay, or the pro version of Financial Juice, okay, first of all, set up an account on Financial Juice, okay, then go to your email and verify your account, then come back to the Financial Juice homepage, and it will give you a little button saying Go Pro here, okay. Once you've clicked that and you've had a little look, you know, you've paid for the service. If you want to, that's totally up to you. Then you go back to your Financial Juice homepage, log out, and then log back in, and then you'll be pro. All right. But again, that's up to you what you want to do and kind of choose. But you can still, as said, use it. Very effective to kind of just to use it by itself. If you don't want to, but if you want it to be even more effective and capitalize on the real-time news, Pro is the way to go. But again, totally your choice, whatever you want to do. Go with that, whatever makes you feel comfortable. So that's the pro version of FinancialJuice. Financial Juice. All right. So we're looking in the S&P there. Let's bring up some of the other currencies too that we're looking at. So let's bring up cable. Okay. That's one as well. Dollar yen, cable, and the euro dollar. Okay, let's get that set. So what am I going to be, so as said, we're going to be keeping an eye out for what the statement says. Okay, and then, of course, what does Powell do in the FOMC press conference? Does he want to surprise the markets? No. Or does the Fed want to surprise the market with a 50 today and then go with a 25 at the next meeting instead? Don't forget, if you have been watching me, or if you've just kind of joined now, don't forget to kind of share it, and you should be able to kind of go back in time to be able to watch some of the past bits. We still got about 8 minutes or so till the rate decision, till it comes out. But as I said, don't forget to like the video, share it, subscribe to the channel. Get the word out there about MACROACE or MACROACE. So if we're going Italiano, maybe don't do that. Maybe don't. But anyway, so that is, as I said, got a bit of time there. About 7 minutes now. Whew. Prata Games says Financial Juice is great. Thank you very much. Right. Okay, so I'll be back in about a couple of minutes. Enjoy the enjoy the silence. Be back. All right, so we have about 4 minutes left to go. I am back on here. So TickStrike, let's get that ready. If you don't know what TickStrike is, it lets you measure the strength of the buying or selling momentum within the markets. Okay, so easiest way to put it, that's if we're looking at another way to, I think, to look at how to understand about TickStrike as well. So here, this is what we call the tickers or the individual assets that we're looking at here. Okay, so this is cable that we're looking at. So you can see there's plus and minus figures. So what does that mean? So this shows you the strength of the buying or selling momentum. Negative being selling and a positive figure being the buying momentum. So here we are. So showing you now what does this? How can you control the level of the strength? So one is, so if you put it on level 1 here, right, on this little slider thing, level 1 is the most reactive reactive to market reactions. Okay. So if there's any bit of buying or selling that kind of goes on, as you can see here, if there's buying going on, then TickStrike will alert you to it via sound and visually as well. I have the sound turned off because otherwise you'd be constantly hearing it, which you don't want to happen. But you can increase that level all the way to level 15, right? Level 15 is the least reactive to market reactions. Okay, so only when there's a big amount of buying or selling momentum that's going on, will TickStrike go off. Okay, so of course you can play with that slider here and there, kind of chop in between 1 to 15, do whatever you want to do with it, make it work for you, and then kind of play around with it and see what works for your trading. But of course, as I said, if you're day trading in life, scalping the markets or jumping onto that volatility, then TickStrike is going to be one of the tools for you to have a look at and to use or play around with. Now, of course, you have the free version here on the website, but that's restricted. Okay, it's restricted to a certain level of sensitivity, and you can't go through any other areas or any other assets. Okay, whereas TickStrike, you have a plethora of different assets to look at. So you have your forex, okay, you have your crypto, all your futures, most of your stocks as well, which we're still working on adding to, and then also ETFs and ETNs, and then your internals as well. So we've got 1 minute left. All right, here we go. Let's see what happens with the release. So less than a minute now. All right. Dun, dun, dun. Let's get ready for this, baby. So let's go on the dollar yen. Got cable with S&P there. Let's get the NQ. Reasonable. All right. Let's see what happens. Okay. So remember, okay, markets are trying to move. Okay, 10 seconds. What are you doing, son? Yeah. Okay, hike, 25 basis point hike, 25 basis point hike as expected. They're looking to the market reaction, dollar seeing move towards the upside. The stock indexes seeing move towards the downside, as is the 2-year bond price. Let's look at gold. I'll also look at the market reactions or look at the text data that's coming up too. So what has the Fed said? In determining the extent of future rate hikes, it will take into account cumulative tightening, policy lags, and economic and financial developments. So a repeat of what's been said last time around. Job gains have been robust. Unemployment rate has remained low. Recent indicators point to modest growth in spending and production. More or less a repeat of what's been said before. Nothing surprising here. In determining the extent of future rate hikes, it will take into account cumulative tightening there. Fed repeats that job gains have been robust in recent months. It will continue reducing its balance sheet as planned. Reaffirms policy framework, including 2% inflation targets. Okay, Russia's war against Ukraine is contributing to elevated global uncertainty and repeats it is highly tentative to inflation risks. Will continue reducing balance sheet as planned. Okay. So inflation has eased somewhat but remains elevated. So there's no talk of easing monetary policy here, or of talking about 2020 at the end of 2024, or a rate cut in 2024, or when a rate cut could happen, if it could happen in 2023. I think that's why you can see that the dollar went up, because there was no comment of easing monetary policy, or a talk of slowing down, or when they're going to reach their terminal rate. So you can see here the US Treasury 10-year yield and 2-year yield rising above 3 basis points after Fed announcement. Okay, futures still price in rate cuts this year. Fed funds rate seen at 4.486% by the end of December, unchanged prior to the Fed decision. US interest rate futures price in Fed terminal rate of 4.94% hitting in June, after the Fed rate hike versus 4.92% just before. So the expectation of a slightly higher expectation in the Fed rate and when they'll reach their terminal rate is what's causing. Okay, this is not nice. This is a horrible market. So that's what's causing the market to move in this way here that we can see. So nothing surprising, but nothing talking about easing monetary policy. Rather, it's the markets expecting the Fed to maybe hit the rate in June, or their terminal rate in June, rather than earlier, or which is what we're seeing as May. In May is when the investment banks were talking about the Fed doing their maybe their last 25 basis point hike, and now that's slightly increased. But again, here we go. What do we see? Yeah, so ongoing increases will be appropriate. So no let up in the statement there. So Powell, more or less, with the dollar's reaction and what we've seen in the markets, kind of did his job a little bit, trying to quash down the expectation of a rate cut in 2023, based on how the markets have reacted. So, okay, the S&P not seeing a nice clean reaction, a bit more whipsaw compared to what we've seen on dollar yen, cable. Yeesh. Damn, that's disgusting. That's a dirty chart. Dollar yen is cleaner compared to everything else. Okay, let's have a look at the S&P. Let's see. First of all, okay, let's measure the move on the dollar yen. So here we go. Cleaner, 47 pips towards the upside there, or 47.1 if you want to be precise. Your Caroline's awesome says my alerts are going nuts. Right, let's see. Who said? Oh no. Oh, feel the fissions at long in crude and gold. Ay, caramba. Okay, hope you're okay. Hope you're okay. Let's have a look here. Let's see what we got on gold. 60. It's about 61 ticks down. Let's look at the S&P. Look at the mess. So yeah, there's nothing. So if we're looking at how the stock market is reacting, one, there's nothing scary. It's more of a reiteration of what's been said in the past. But for dollar traders, particularly on the dollar yen, you've seen strong affirmation that they're going to continue to do what they need to do and raise interest rates, whereas the Bank of Japan is in a lull, more so compared to other central banks. And that's why cable, euro dollar, not seeing clean reactions compared to what we've seen on the dollar yen. So there we go. S&P 80 ticks down. NQ. See what's up with you. Let's go from there. Okay, let's go to the wick. That's about 267 ticks down. Cable. Let's see, what did you do? So this is why I always like to try and capture the initial market reaction. See, how much volatility was created off the back of a bit of data. And then post 10 minutes, kind of, that's it. Well, the volatility might have peeled off before then, kind of gone back to pre-market. But there we go. That's a 25.5, 25.7 pips there on the euro dollar. So dollar yen being the biggest mover, as we noted in the deviations for the economic release in the past, but also in past economic releases too, for non-farm and the inflation data too. It's been the, oops, sorry, that's the wrong one. There we go. There. Okay, it's 25 ticks down on the 2-year bond price. All right. Bali days that suddenly nothing happened. Okay, there we go. Yeah, the markets have reversed on the S&P, or excuse me, NQ and S&P. Dollar yen still kind of holding ground. It's still holding ground up top there. Cable, euro dollar. Yeesh. Yeah, it's not nice. All right. So, right, that is more or less the summary. Well, that is the interest rate decision. It was boring, but it wasn't that boring in the volatility that was created off the back of that. Don't forget to like the video, subscribe to the channel, share the video as like a reminder, like, hey, I saw this guy last night and he provided some good detail that I found useful. If you did, of course, right? Don't share if you didn't find it useful. If you didn't find it useful, please, because I don't want people hating on me saying, this guy sucks. Where did this guy come from? I don't want that happening. Please. So just keep it nice and chill. If you liked it, genuinely, then put it out there. Get the word out there. It's me. It's the Tony speaking on the mic. But yes, so remember, the deviations is completely free. I've put the link in the in the chat. Jonathan Weatherall says, "This guy sucks." Lol. This was a weird, good American accent. I'm not good at doing American accents, but hey, anything goes, right? Of course, as long as YouTube. Oh, holy YouTube is all good with me. But I think we're all good. So yeah, as I said, that is the economic release. Now, don't forget to jump on to our, as I said, subscribe to the MACROACE mailing list. I think it's probably lost in the chat now. I'll put it out again here for you. Right, that is the list there for you. Enjoy the show. Thank you for your patronage. So that is that's MACROACE. That's MACROACE there for you. Let me get the next stream that we're doing. We're not done yet with a week. Okay, we are not done yet. We have ECB and the Bank of England tomorrow in the morning. That's at 6:30 a.m. Eastern time. I'll be starting that nice and early, right? And what I want to do now is just get the video for you. Also, don't forget, we have unusual activity as well. So if you like trading unusual volume activity in stocks, bonds, crypto, and FX, right, and futures, then you can use unusual activity for completely free beta test of our new service that we have, and jump on that bandwagon and have a little play with that as well. Let me grab the video for you. What am I doing? Come on, son. Come on, son. All right, here we go. There it is. That is the live stream for the, whoops, No. That's the live stream for the video there. Let me remove that. There we go. So the bottom one there is the live stream for the video tomorrow for the Bank of England and ECB, where they're expected to deliver 50 basis point hikes, both respectively. For, of course, ECB with the deposit rate and their marginal lending and the marginal facility rate and the marginal rate, or their interest rate, as we call it, their main refinancing rate, So that's there too. And then, of course, non-farm payrolls, which we have on the Friday. We're not done. Still not done yet. We got, let me get the link for that too. So if you're not used to how kind of do things, I kind of, jump in maybe half an hour earlier or maybe an hour earlier if it's an interest rate decision, depending on which interest rate decision is. Like tomorrow, it's going to be 30 minutes before the Bank of England, because they've had, decent market reaction in the past, but not as big of volatility compared to what we've seen with the US. But still quite important though, so you can't miss it out. All right. Okay. That is everything there for you. Thank you very much for joining me live. Enjoy the rest of your evening, and I will see you guys tomorrow in the morning. All right. Sayonara. Take care.